PayPal is a company that has fallen massively in price. Whenever we talk about all these companies that we want to buy and everybody says, oh my God, there's no way they're going to fall, I want you to go back and look at these stocks. So this is PayPal's stock price over the last 1 year. It hit a high of $310. It hit a low of 82. That's a fall of almost 75% for a company like PayPal. These things do happen. Overpriced companies eventually come down to reality, and they give you an opportunity as an investor to buy. Now, of course, there'll be an excuse given as to why PayPal has fallen 75%, right? There's always an excuse given. Just like when it's rising up to nosebleed levels, there's a reason given for that. Just remember this as we go forward. When the stock is down, the news will focus on the news and the information that justifies why the stock goes down. When the stock is going up, they're only going to focus on the information that makes the stock go up. That's it. Notice on a day-to-day basis, if the markets are up, the news will say, markets are up because this information came out. Guys, there's 10,000 of pieces of information that come out every single day. And there could be a million reasons why. They just fit the news to match the result, right? Same thing with PayPal. Now remember, what we're trying to teach here on Everything Money is this value investing process and approach. That involves taking out all the noise. So I like PayPal. My friend Mo on the channel is not a fan of PayPal. Why? He thinks there's too much competition coming. And I get that. There is a lot of competition coming, but that's not news to me. To me, there's very few companies out there in which you're not going to battle for competition. There's Square, there's Stripe, there's all these other processors out there who can fight PayPal. But my focus on PayPal is it's easy to use and it's trusted. That's the big thing. It is trusted. Whenever I buy a product that I want to be able to easily fight if there's an issue, I buy it through PayPal immediately. PayPal owns Venmo. These are very easy things. The Venmo has become a verb. Venmo me. No one says cash at me. I mean, they do, but Venmo me. That's a very common thing. I have people who do work at my house, and when they started to work for me, all three of them didn't use Venmo. I'm like, God, get on Venmo. Now I see them. They have 100, 200 friends on there. They have transactions always occurring. Literally me saying, hey, I need you on Venmo so I can pay you. Got them immediately. All of a sudden, they're doing lots of transactions because it's easy to do. So I look at PayPal as a way of making it easier for the consumer to use the product there and make life easier for them. So what am I focused on? Am I focused on the day-to-day results? Not necessarily. So let's look at those results. PayPal, their total payment volume was up 13% to $323 billion of transactions that occurred in the first quarter. Number two, their net revenue was $6.5 billion. That's up 7%. Is that a ton? No, I get that. But remember, PayPal surged last year because of and the year before because of COVID. It allowed people, since they couldn't go out there and buy stuff, they had to do things at home, and PayPal surged. So this is still 7% growth on the surge that it came off of for last year. That's big numbers to me. Now, their GAAP earnings per share dropped big time. They made 43 cents per share versus 92 cents in Q1. And their non-GAAP earnings were 88 cents versus $1.22. But here's a big thing that I like. 2.4 million net new active accounts added in Q1. So even with all the competition out there, even with everybody out there competing with them, Apple Pay, etc. And by the way, with Apple Pay, I use Apple Pay as well, and it's great. But I still find it to be sometimes a little bit harder. When I want to change a card out, it's actually easier for me to do it in my PayPal account on my phone than an Apple Pay on my phone. That to me is pretty telling. So, what are they expecting for the fiscal year 2022? Revenue expected to grow 11 to 13%, with surpassing 1.4 trillion. Now, guys, the reason I talk about this is it does matter to pay attention to. But I look at PayPal as a great company with a great balance sheet. We'll get that in 2 seconds. So all this extra stuff, if I don't believe in the business model, this kind of validates it, but I'm not focused on the quarter-to-quarter results, right? So they're growing the TPV, total payment volume, to grow in the range of 13 to 15%. Their revenues are going to grow 11 to 13%, and that's excluding eBay. GAAP, they're expected 219 to 234 per year on GAAP earnings for this year. And the non-GAAP is 381 to 393. And they're expecting to add 10 million net new users to their system this year. Is that a lot? Well, you have to go look at their 10K and figure that out. But let's look at PayPal from our perspective of valuing the company and do we want it or not. So 8 pillars. Guys, first off, this is a $100 billion company. And keep in mind, it's $100 billion now. But when it was $310 a share, it was almost a $400 billion company. And go look at our past videos. I'm sure it said it was massively overpriced. People probably said there's no way. I highly encourage that to happen at some point. Pillar number 1, we want the 5-year PE being under 22.5. It is 33. That's an X. Now keep in mind, that number is going to fluctuate. The PE you want to pay is going to fluctuate based on growth potential. The higher the growth potential, the higher PE. So that in and of itself does not say that it's expensive or not. Okay? Pillar number 2, we want the 5-year return on invested capital to be greater than 9%. It's 12.6%. All right. Keep in mind, not a pillar, but our 5-year average free cash flow is $4 billion, and last year they did $5.4 billion in free cash flow. So it's growing there. Okay, pillar number 3, we want revenue growth over the last 5 years. So we go to the income statement on our Everything Money software. 5 years ago, 13 billion. Last year, 25 billion, almost double. Check mark there. And guys, look at the last 10 years. It's just growing slowly, but not even slowly. It just grows every single year. Okay, pillar number 4, we want net income, which is profit growth over the last 5 years. So we scroll down a little bit on our income statement. 1.8 billion to 4.17. Check mark there. All right. So now remember, they just announced profit for the first quarter is down, and they were talking about $2 per share for the year. I'm going to go ahead and say that is going to be lower this year than it was last year. So keep that in mind when you're valuing the company. All right, pillar number 5. Now, this is a very important one. And for those of you who are new watching the channel, nobody looks at these. And I want you to become an expert in this. We want shares decreasing. What companies will do a lot of times, and they're expensive, they'll issue a ton of shares because people will buy it right and left. But as an investor who has been in the company, you are being diluted as time goes on as they add more shares. So we want them removing shares from the market. So years ago, they had 1.21 billion shares. Now they have 1.17. So they're buying back slowly. Now I will say, we don't want them buying back expensive shares. So that's kind of a concern. But the point is they're not diluting the crap out of you, which I'm happy to see. All right. Pillar number 6, we want their long-term liabilities to be easily managed by their cash flow. This is how companies stay around when times are tough. The ones with the most debt have the biggest problems. So what do? We go back to the main page of our software. Remember that 5-year free cash flow number of $4 billion? We multiply that by 5. We want their long-term liabilities under $20 billion. Very simple. So what do? We go to the balance sheet of our software. We scroll all the way to the bottom. Long-term liabilities are $11 billion. So it's almost half. So they can easily manage this cash flow, the long-term liabilities in this company. All right. Now, I want to point out one other thing. Total cash on hand is $52.6 billion. All liabilities are 54. So they can almost write a check for all the liabilities in the company pretty easily. If they do that check plus 6 months of free cash flow, they're completely debt-free as a company. That's the kind of company that has staying power. And that's a big reason I like PayPal. Pillars 7 and 8 have to do with cash flow. So we go to the cash flow statement on our software. Now remember, guys, free cash flow is cash from operations less your capital expenditures. You can do 5 things with those. You can pay down debt, buy back shares, make acquisitions, invest back in yourself, and pay dividends. So this is the lifeblood of the company. So we do the math here for you on our software. We added this line here. 5 years ago, 1.86 billion, now 5.4, check mark there. Tripling, their free cash flow has tripled in the last 5 years. And guys, look at this free cash flow, just growing every single year. Now, obviously, there's some drops here and there, but the point is, this is a growing business. Now, remember, PayPal used to be part of eBay. They spun it off. And finally, guys, we take their 5-year average free cash flow of $4 billion, multiply it by 20 for a starting point on a market cap we want to pay. That's $80 billion. If you remember, the market cap was about $100 billion, so it's overpriced according to this. So, guys, this is a lot of math. Let's go to our 8 pillars tab. 8 pillars tab, and look at this. This is a company that has all the attributes. It's just maybe a little expensive. Now, again, does that mean it definitely should be ignored? No. If PayPal is going to grow 30% a year for the next 10 years, would you buy it at this price? Absolutely. But you got to sit there and go to our stock analyzer tool, because every investment is the present value of all future cash flow. And we don't know the future, so we have to make assumptions. So that's why we created the stock analyzer tool. It allows you to input those assumptions. So you can do 1 to 20 years. I always pick 10. And the reason being is, do I believe this company will be around for 10 more years? If the answer is yes, and I think they're going to still be dominant in their market, I'm going to analyze the company. So let's go in here and do some revenue growth numbers. I'm going to sit there. My job is to be conservative and buy companies under their conservative numbers. So I'm going to go start conservative out with 4, 8, and 12% revenue growth for the next 10 years. Okay? I'm going big ranges here. Profit margin. I'm going to go, it was pretty good the last couple of years, so I'm going to drop this a little bit. 11, 13, and 15%. Free cash flow margin, 18. Let's go 17, 19, and 21%. Because with competition, the margins will probably decrease, so I'm accounting for that here. PE. I'm going to go 13, 15, 17, 13, 15, 17 on also the price of free cash flow. And everyone, I'm going to do 12.5% return, because you can buy an ETF and make 9 or 10%. So I want to make sure that I have my ample margin of safety and put it in there. Hit the analyze button. Boom. So in the mid-range, in the low range, I have 30 to 45. High range, 85 to 120. Middle range, 50 to 75. So what this means, guys, is if you believe this high range right here are possibilities, then you'd be buying PayPal stock right now all day, because it's below both of these numbers. All right? Now, spoiler alert, I have options. I have put options written starting at $75. This means I want to start a position on PayPal, and I want to start at $75, and I'm selling puts to get assigned those shares at lower prices if it falls there. It's not far from there. Does this mean I'm buying it all day at 75? No, I'm starting my position at 75, and as it goes lower, I'm going to keep adding. That's the point of what we're trying to do here. You're never going to pick the bottom. You're never going to pick the top. So your goal is to dollar cost average on stocks that you like as they go down in price. PayPal has a lot of downward pressure on the price. People are expecting a lot from it. So I'm just going to be patient and wait there. That's the key to what we're trying to accomplish here. We're trying to teach a process of patience and emotional stability when looking at investment. Now, your goal is to always focus on the long run. If you choose to buy PayPal and you think you've paid a good price today, all you should focus on is looking at the news every so often, every quarter. Has anything materially changed in the business that changed my thesis? Just because they missed by a penny or missed by 40 cents, whatever it is, are they still growing? And is that growth going to justify the price you pay? That's the key here, and that's what we're trying to teach. Thank you very much.